Bob's bullish on RIOT stock, and he wants to know, would the married put be the best play with this? I'm going to say probably not. Even though you know I advocate the married puts, you've all heard me say that it represents about 50% of my portfolio. And yes, I'm hitting my targets, otherwise it still wouldn't represent 50% of my trading portfolio. The structure that I use, of course, following the married put concepts that's described in the blueprint. I won't do the promotion now, I'll save that for the end, but yes, we're running the end of the year bonus promotion for the blueprint. I want a structure where my put is 5 or 6 months out in time or more. To follow that decay curve we talked about, we're going to address in a moment for Wendy as well. And I want it to be in the money to follow the proper 3 core principles that we discussed in a recent webinar. And I want to have a controlled risk of 4 to 8%. Personally, I'm about 3.5 to 7.5% with most of my positions. Why I'm saying that, the preferred structure, is because of the volatility of RIOT, RIOT, likely won't match the criteria that I want. Meaning, Bob, I'm probably going to have to go 40% in the money to see single-digit risks. Are you 40% bullish or expect to see the stock move up 30, 35% in the next 30 to 60 days? That's a tough one. You could take the higher risk and still see potential profits, Bob. That's very true. But you're not taking a single-digit risk with the married put position. You're going to be taking a double risk. So normal structure I would look for, I'm just going to use mine. This is one I bought into a few days ago. Different prices, but Ritchie Brothers at 70.34. I'd buy the June 75 put that's 170 days out in time for about $9.50. That puts me at a nice, comfortable risk of 6.4%. That's where I want to be. I'm not too deep in the money. We're only, I don't have the column here, but we're only slightly in the money, about 1 strike in. So if the stock goes up to 74, that's the important time when I'd start doing the income methods discussed in the blueprint to lower this initial at risk and potentially bulletproof the trade, only to cover 6.4%. Probably could do that in 2 right cycles. Now, for RIOT, as I mentioned, I'm not going to see single-digit risks. Let's go to RIOT. Now, I don't know its expiration time frame, so I'm going to try to find the furthest one out. We saw June, that's good. Let's go to January. Let's go to June. Same thing that we just saw with RBA. And I'll go to more results for now. Okay. Stocks at 1726. Okay, good put target off the top of my head would probably be around 19 or 20. I think this is a good range in the money for me. Let's just check. So I've got to add my column in. And I want percent in the money. Sorry, yes. Okay. All right. Okay, so that's where I would that's exactly where I would normally target. 10 to 15% in the money. We don't like to go more than 20% of the money, but look at the risk. 30%, 29%. This premium on the $20 stock, that's funny, the premium on the $20 stock is higher than the cost of the June in the money put for the $70 stock on RBA, isn't it? Wow, that's phenomenal. This is what volatility is. This is how it can affect you. This is not to say that these aren't going to be profitable, Bob. It's just to say with the volatility of these type of securities, even lower priced pharmaceuticals that you see from time to time, is you have to take the good with the bad. The option premiums look good. I want to take advantage of the upside in this case. It's going to cost you. It's going to be expensive. With a married put, this could still be a profitable position, but you're taking 3 to 4 times the risk we would normally suggest taking to stack the market odds in your favor with this structure. Okay, so that's the risk there. Would the married put be the best play? I don't know your goals, Bob. Meaning that if you want to hold the stock because you want a 1-to-1 delta appreciation, you may just want to buy the stock, but that's going to take the risk. Does the married put protect the position? Absolutely. But because of high implied volatility, it's 3 times what you would normally see. What I would normally target, Bob, is what I mean. A couple of weeks ago, we discussed a standard collar on the position that would still leave some upside open for you, but at the same time, have protection. So in a standard collar, I might go out a couple months, not as far as June. Let's just go to February. Let's go 51 days out. And I might sell, say, the 19 call at 4, buy the 13 or the 12 call at half the price. Does this leave your upside open? No. So if you're expecting a large run, Bob, this wouldn't solve your problems. But it does set me up in a structure where if it runs above 19, I can make 24% by being assigned on this covered play while having still double the normal risk I would like to take, but only having a risk of 15% if it falls below 13. And if the stock doesn't move up by February, it goes up to 18 and stays there, well, both your call and your put expire worthless, and you could rewrite the collar for the next cycle. Another idea, something similar to this, doesn't leave the upside open. So again, you have to ask yourself, Bob, are you expecting the stock to run and you're expecting outpaced moves of 15, 20, or 30%? Or are you expecting the stock to fall in that case? I'm sorry, not fall, my apologies. Or are you expecting a smaller run up in price? If you're expecting a smaller run up in price, the collar, or maybe even an at-the-money bull call debit spread, selling an 18 strike call and buying a 16, for example, would still give you maybe a 1-to-1 risk-reward ratio, but it wouldn't leave the upside open. If you are expecting that 20, 30% move of the stock to really take off and show a lot of movement, the married put is the right idea to leave the upside open. Absolutely. But you're still going to take on a much higher risk. Buying a call would do that too, but you're going to be paying, again, 4 times, 5 times more than you normally would for a call trading on a stock at a similar price as well. Okay? So it's a debate. You could go either way. Let me go to all results here. Let's go back to our view on RIOT. Yeah, you're not going to find single-digit risks here, even going almost 100% in the money. Going up to the 30 strike still carries a risk of 17% because of the volatility in this case. But you're very hedged out. You need the stock to move up to 25 or 26 before you could really start doing adjustments on this position to start paying down the risk. And it's still double digits, still double what I would look for at the highest, and you're 73% in the money. Okay, that's kind of tough there. So again, it's not to say that either one of these two won't be profitable. You're just deciding and admitting that you have to take the risk that's 4 times, 3 times more than you would normally take. Next up, Frank. Frank says a lot of stocks are making all-time highs. This leads to a series of all-time highs. What's your suggestion on the proper way to play an all-time high? Well, in general, I tend to use the married puts, as you know, Frank. Sorry. If I'm interested in a stock that's hit an all-time high, it comes up on my search. Yeah, I'm buying the put option on it to control my risk to 5 or 6% if it starts to pull back, and then I'll still be able to adjust the position. Let's go here to the market sentiment tool. I'd like to stay in this for Alberto's question, but Alberto's question is actually 2 back, so we're going to have to take Lloyd first before we get to Alberto after this. Number of percentage of stocks 52-week high and low. Is that the one I want? Yeah. Yeah, okay. So right now we're getting to that point. We're getting to near the fence. So this is bearish when it's above 8. Where's my fence? Oh, it's only at 3.6. Okay, so the stocks of new 52-week high lows at 3.6%. This indicator typically turns bearish when we hit 8. Okay. Now, we're in a strained market. We know that. We're in a strained and strange market, Frank. Kip already mentioned to us this comment of how he feels, this comment of how interactive brokers, investors are actually net short compared to other investors in Robinhood that seem to be net bullish. That's a little bit of a clash there, maybe old guard versus new guard as far as options traders go. I'm not saying I'm short in this position. I still have some long positions open, and I have my hedges in place as well. But then again, it's tough to say, isn't it? Why do I say that? We know that there's new stimulus coming in, and we know that's going to be pumped into the market to keep it afloat, to make big money happy, I guess, is lack of a better term. We know that the market's on edge. We know the economy, is on edge, not the market itself, but the economy is on edge. Someone at some point is going to look, this could be 8-10 months down the road, but we know somebody at some point is going to turn around and look and say, so you know that $3 trillion so plus thing we did to the deficit, we should consider something soon, and that's going to cause some problems. That's going to cause some panic, honestly. I'd still like to be in a married put, because if the market falls, hey, in March, remember, married put portion of my portfolio from February 26th to March 3rd was only down 3%. I was long 4 stocks. Some of them were down 29%. I was down 3%. Okay. And where am I going with this? Well, there's a lot of stocks that hit new highs, and there's a lot of stock that keep hitting new highs. And the new high is only the newest high until the next new high is hit. If you have an unrealized gain in the position, you should be buying a put using that stock insurance tool we have on Power Options to find positions to lock in the gains if you're worried about a decline in a pullback. What we talked about a moment ago with Alexander is also very useful too. Still continue the trades you might be doing, Frank, covered calls or other positions, but considering a market hedge with some various shares of, say, a volatility ETF, or perhaps buying puts on SPY, QQQ, or things of that nature to help hedge the portfolio long term. I have no specific strategy, to be honest with you, to say, oh, this is at an all-time high, so I'm going to do strategy X over strategy Y. I'm still going to be doing bull put credit spreads for the moment. I'm still going to be doing, the married put positions and managing the open ones that I have. I still have a couple of calendar spreads open, and as I mentioned, I have my hedges in place. Sam doesn't look like he's with us today, but I know what Sam was probably doing right now, and what he'd tell you, Frank, is that, not here, of course, let's go back to another security. Let's take just SPY. And I use SPY just because it's easier to view with the smaller prices rather than looking up SPX or NDX. So his approach, and he's probably been in them anyway, he might be out 2 to 3 months with a long strangle position. Okay, so he's in a long strangle, whereas if it keeps going up, he'll start seeing potential here, and he'll try to move or adjust this put or pay for this put by selling out of the money naked put positions on SPY, and sort of just keep bracketing this position. And then if it falls, well, he's going to lose on the call, but now he's making on this put series, so he might do something else in that case. So is the strangle a good idea when the market keeps hitting new highs? Well, absolutely. It's a good play. It's also a good thing to use for some income, but it shouldn't be 20%, 30% of your portfolio. It's just something that's a smaller portion. So think about it here. We were coming off the rebound, of course. This is a bad example, but we were at new highs here, another new high here, another new high here. Is the strangle helping you if I'm out to a strangle here? Yes, because the call is gaining in price. I'm losing on the put, but maybe I'm selling some cash secured naked puts or bull put spreads to help pay for that long put that's out in this time frame, and then you get the fall. So now your put's profitable. You hopefully locked in some of the profit on the call in this case as well, and then you readjust the collar. Looks pretty good, and then September hits. Looks pretty. Did I reverse that? Is that September here? October, November, December? I did. I'm sorry. So this was the September decline. This was that peaked October, and then the October decline. November, new high again, new high, new high, new high, new high. Yeah, so at this point, your call is making money, the put's losing, but you could be doing stuff here. And then if there's a fall soon, well, the put's going to counter that, but it requires management, as you can see. Frank, that's the case. This requires, this strategy I'm talking about, using a straddle. It's not just put it on and walk away. It requires management. You've got to pay for the cost of the one that you're losing on somehow, which takes on risk. If your timing's off and it falls on you while you're in a bull put or the naked put position to hedge the long, that's a possibility. You still should be net bearish to that side with the structures that I'm talking about. But again, that's what you look for. Okay. All right. So that's it. I'm sorry, Frank. That's it. Even with all-time highs, I'm still looking to open married puts. I'm finding married put positions. I might shy away from something that's just rocketed up and has a very high Bollinger Band range and has a, I'm sorry about that, Frank, a significant run. This spike happened before I got into RBA. I got into RBA here, okay? So the stock's at a relatively new high, and it's kind of middling about, but here was also a new high, and then it hit another new high, and then it hit another new high. Tried to come back from that, but pulled down recently. It's trying to move up, but I don't like that. I don't like that little negative MACD line I'm starting to see on my RBA married put. Might be a time for an income method number 12. Might see what happens tomorrow in that case. Everything else I had today really moved up well. That DAR position, the darling position, and AEM moved up well. That was another married put that I'm in also. So they moved up pretty good today. Darling especially. Yeah, it's up 258 to 58.88. AEM is up 95. And Kraft fell, which I'd like right now, but I don't know what I'm going to do with that. I'm just going to close it. I've essentially already closed the Kraft position, but I was looking to do an income method number 7. I just haven't yet. All right, let us go back. We were talking about the market sentiment tool. I used that for our discussion with Frank on these numbers. I was looking at those indicators for the percentage of new stock, 52-week high and low. We saw it's nearing the fence. The fence is at 8. That's when we're going to hit the bearish trigger here, but we're at 3.6%. What does that mean? This means this histogram over time is when that number starts to get, that percentage starts to get up to 8. You usually don't see it go any further, and that's when the market starts to retrace and stocks start pulling off of their 52-week high, and you may see more stocks hitting their 52-week lows there. Alberto, in one of your last webinars, you were talking about the market sentiment. If I remember well, you said take notice when you had 3 consecutive bearish signals. Can you please tell me how you would manage your existing married put position when that occurs? Absolutely. Do you just use the market sentiment window and power options, or do you use other resources? I use other resources too, Alberto. First off, view overall sentiment history. So here I'm going back. There was a bearish sell in 1124. It didn't hit 2 or 3 in a row. That's what I was waiting for. Why? Oh, I'm going back to here. There it is. 825, August 24th, August 25th. That's the last time we saw these the 2 or 3 bearish sells in a row. What happened right after that? That September decline, which was almost a 10% decline, if you remember. Okay, so what was I doing with the married put positions? I should have done something very different with AEM, and I didn't. I missed the boat on it. That was my mistake. But the other position, so I'm in a married put. They've been running up. They're at or near my put strike price, or maybe a little bit above. If they're above my put strike price, Alberto, for the married put, and I see 2 or 3 bearish sell warnings in a row, if it's right, I'm going to do income method number 4, cancel some of this risk, and I'll sell the call maybe 20 to 40 days out in time, right? So we're going to lower the risk by using income method number 4 first. That's what I would do in that case, if it was at the right price. So it's above my put strike price. We lower the risk with income method number 4, and then we pay for that debit of income method number 4 by selling a call. Why? Because typically when we're right and the market pulls back, I've canceled most of my risk, and then I help cancel more of the risk with the income method number 1 that's now deeper out of the money, expires worthless. I can choose to leave the position as is with the higher strike put, or readjust it if I think the market's now bottomed 20 to 40 days after that decline and is looking to come back up. But you would do something following the SIGA model in the blueprint, Alberto. That's what's discussed in each of the income methods. What are the good conditions for selling the call? The stock's moved up as you expect and is at or near your put strike price. You've been on a good market run. You have an expectation or fear that the market might hesitate or pull back. That is the prime time to sell a call. You don't really want it to continue to go up here. If my SIGA model during a trade, I don't see these bearish sells, the stock's moved up to my put strike price or a little bit above, and I think the stock's going to continue to go up, that's the last time I want to use income method number 1 to sell the call. I'm going to leave it and let it go, or I'm going to use income method number 6, the bear call spread, to leave the upside open. Or maybe the ratio call spread, income method number 5. I don't know. That depends. Now, I see the 2 bearish sells on 825. What am I doing? I'm adding hedge to the bull put portion of my portfolio. I'm selling calls against my married puts, potentially rolling up the puts via income method number 4 to lower the risk in case the decline happens. If the stock keeps coming up, for whatever reason, some news changes and the market keeps going up, which of course it did from this point, but not before the 10% decline, right? In September, that's what I was hedging against. So I lowered the risk, added income to help lower the risk further. And that's what I did. What I should have done with AEM, and I didn't. I ended up selling a call on AEM at that time. I have to remind myself, I might not even been in AEM. This might be something different. I wasn't. I'm thinking of the other position I closed in the Fusion portfolio. I'm sorry. I got into AEM at 11.9. I didn't see 2 bearish signals, but what I should have done that I haven't done on this position, oh, that's not the right time. This is the webinar account. This is the here. My cost on it's actually 83. This is where we got into the position, is right about here. Now, I did it all at once. I rarely do this, but the premiums were really good. So we got in here just about the worst possible time on AEM. And I saw that signal. So what I did is I sold the September call for this expiration that was a 75-cent premium. It's a good, reasonable price. So that was my hedge, and it fell, but then it started to come back up. So rather than do something else, especially when I saw the MACD go negative, I left it alone. Meandered about here, got another call premium. It didn't really go above 85. It's meandering about here. Then we didn't have 2 sell warnings in a row, but we had one at the beginning of November, if I'm not mistaken, or the end of October. That one little sell warning that popped up. It wasn't 2 in a row, it was 1. But when I saw that, and this dipped below the 20, and then MACD went highly negative, I should have done income method number 12 right here. Well, I would love to have done it right here, but at this point, I should have done income method number 12 for this, and I didn't. So now I'm in the discussion of, do I still think this stock's going to be bullish? Hey, we've got the positive crossover. We're going to use income method number 9 here, but the prices weren't right. I'm probably going to use income method 9 very soon on this position. But then again, we were talking about the concerns going forward. Okay, so this is when I should have used 12 on. At this point, the stock was down, I believe, 17% from where I bought in. We were at a loss of 5% on the married put position, such as life. Darn, you know, it is what it is. I should have used, if timed perfectly, I would have used 9 right here. And yes, as after it's moving up, but that would have been a great time to lower the put from the 90 strike down to the 75. Would have done 2 income methods already to cut the risk down on the position. But I really, really would have done 12 here when I see this kind of breakdown, this MACD crossover was 1 bearish sell warning, but that's enough. Why didn't I do 12 over here when I saw 2 bearish sell warnings on August 24th and 25th? It's because I was in the positive zone for the things I wanted. Here was a breakout, but the MACD hadn't gone negative. This was the time to use 12. This is the time to use 9. Okay. So I'm likely going to use income method number 9 on that soon. Okay. So when you see the bearish sells, what do you want to do? You want to do something that's going to give you income and reduce your risk before a decline. And that could be related to the income method number 1, selling a call against the position, maximizes the profit, right? It's not like one of the riskless spread trades that takes some of the premium away. But you'd look to sell a call in that case, get some income, because if the stock does fall based on the market sentiment indicator, you're going to be able to buy that call back cheaply. Even if it only falls for 4 days, you're going to be able to buy that call back cheaply. If the stock has run up, as it usually does, before you get to those sell warnings, it is trading right near your put strike price, or even a little bit above it, that's a great time to move the put up. Yes, you're adding cost into it with IM number 4, Alberto, but that's going to cut your risk down by half. Then you can still sell the call, and when the decline happens, you're only about a 3% loss, and you can still manage the position with the other income methods after the decline is done. Okay, so I don't just use the market sentiment window, but typically when I see 2 in a row, I'm going into my portfolio, hedging the leverage portion of my portfolio, probably selling calls against the married put positions as well. I haven't seen, as I mentioned, 2 to 3 bearish sells in a row, although we saw several sell warnings recently, but there has been some easing slightly, so we're back to neutral. We're at 3 negative, 1 bullish, and 9 bearish. Had a lot of sell warnings in a row, and I think we had a strong, yeah, there it was, 1124. But it wasn't 2 in a row. There was some hesitation. And the market was still hesitating, and it started to move back up again, started to pull back, and now we're back up to here. Why? Well, all the news on the stimulus, right? Wasn't the max that was hoped for. It wasn't the max that was asked for. But it is through. And it's into law now. So there's going to be more Fed money coming in, not only to individuals, but also, of course, into the market, into other things as well. So when I start seeing 2 bearish sells in a row, you'll hear what I'm going to do with my positions. Alberto is a Blueprint owner, of course, or as a Fusion subscriber. But Power Options members in our YouTube community will also hear about it on our Friday sessions, what I'm doing once I see those as well. I'm on my webinar account, so I don't know how far back I can go. That's not good enough. Let me pause the screen again. And let's log out here. But here we are. We're on my actual account that's real time and has the full history instead of our webinar account. What I want to do is go back to January 26th, 2018. Look at that. Look at that. Remember this? Remember this time period? This was similar. Look at that. I mean, just the end of 2017 to 2018. We talk about how good the growth was in the market the last 6 months after that decline. But remember what happened back from July essentially to January. I'm sorry, July of 2017 to January. Yeah, a little hiccup here and there, but my goodness, it was a lot of fun. Okay, that was a lot of fun. Something was going on. Something was going on. And what actually happened is the market sentiment picked it up better than I could have ever expected. Meaning that you start to see January 1st, 2018, a bearish sell, very bearish sell, bearish. You know what I was doing at this time? I was loading up on calls in the VIX. And when the market's doing this down here from 2017 to 2018, it's when the VIX was at 10. The VIX was at 9 at one point in December, I think, of 2018. 9. I was buying 14 strike, 16 strike, and maybe even 13 strike calls for March expiration on the VIX because this was going nuts. And of course, remember what happened. It was only a 3 or 4 day period, wasn't it? But that February 5th to February 9th decline in 2018, which was essentially the start of the tariffs and the trade tariffs and the China trade wars, it wasn't that big. It went from 2,900 down to 26. It was more than a 10% decline in 3 days. VIX moved up from about 10 to about 40, if I'm not mistaken. It wasn't as big as the movement we saw last March. That's still significant. But at that time, what else was I doing? Buying those calls on the VIX, or sometimes I might consider now buying puts on SPY, as we talked about earlier, for Alexander. That was to hedge the bull put credit spread portion of my portfolio, that if some sudden event happened, which the market sentiment said was going to, was pointing us in that direction, a sudden change on a 3-day time period. In the first day of this movement, I had 3 bull puts open for the 9th expiration, for February 9th expiration. On February 2nd, they were all profitable, not 50% profitable. They're all 20, 30% profitable with 7 days to go. And that first day on February 5th, they were all at a 49% loss. That portion of my portfolio was down 49%. I closed all the positions. Why? Because 2 days later, all those spreads were at a 90 to 100% loss. That's how steep it was and how sudden and too darn close to expiration for the spreads. But I didn't take a loss because the VIX calls more than countered the loss I took on the bull puts in this example, and also hedged all the losses I took on my diagonal calendar spreads. But on or around January 20th, January 23rd, I started rolling my puts. No, it was before that. I apologize. I think it was the 13th or 15th of January. In the midst of all those sell warnings, Alberto, I started to use income method number 4, and I sold calls as well to hedge for this planned decline. And what I don't want to say planned decline, that's a terrible term to use, but I mean, you see it here. These are all the red flags I potentially need to say, yeah, I want to lose some of this risk, and I want to sell some calls here to even further that risk. And I think one position, I even did the income method number 12 to turn it into that V profit and loss chart. And for the rest of my portfolio, that's where I had the VIX calls, Alberto, and more. I just use this as the prime example, and it works for me almost every time. September, it worked. You saw that. August 24th and August 25th, we had 2 bearish sell warnings in a row. And mine here, my personal one, let me check that. Oh, yeah, okay, I was still 2. August 24th and August 25th, I was still 2 bearish sell warnings, 7 and 7 on this one that triggered, and that led right into the September decline. We hedged against it. And unfortunately for that AEM stock, as I mentioned, where I could have used 12 later on, it wasn't that time, but I'd already committed to selling the call as the hedge, which worked out perfect. But then the stock kept exceeding negative expectations. It kept working against me more than I expected. Should have used 12 on that one, and I didn't. But hey, I'm only sitting on about a 6% loss. No, I think it's about a 6.5% loss on AEM right now, and I'm going to look to manage that, as I mentioned, with income method number 9 as well. All right, so let me just review your question here. Okay, so I think I've answered that for now, and we'll have more discussions on that later on the bullish side as well.